Listen closely, trader. There's a number on your chart right now bouncing between 0 and 100 that 97% of traders are reading completely wrong. They see it flash 70 and they sell. They see it flash 30 and they buy, and they lose again and again and again and again. But what if I told you that this very same indicator, the relative strength index, built fortunes for the men who knew its true secret? What if the three strategies I'm about to share with you today are the same hidden patterns that separate the consistent winners from the desperate gamblers in this game? Stay with me for the next 35 minutes, because what you're about to learn could very well change the way you read a market for the rest of your trading life. But before we dive into the meat of today's lesson, I want you to do something for me. Look down in the description of this video. You'll see two resources I've prepared specifically for traders who are serious about transforming their results. The first is my ebook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. This isn't a get-rich-quick pamphlet. This is the distilled wisdom of a lifetime spent in the pits, the bucket shops, and the boardrooms of Wall Street. It's the mindset that turned $5 into $100 million during the crash of 1929. The second is the Livermore Journal, a 90-day trading psychology workbook. Because here's the truth, my friend, knowing strategies is only half the battle. The other half? It's between your ears. This workbook will rewire your trading psychology in 90 days, page by page, trade by trade. Both links are waiting for you in the description below. Grab them now, because you'll want them by your side as we go through today's strategies. Now let's talk about RSI. Pull up a chair, trader. Let me tell you a story. Back in my day, we didn't have computers. We didn't have flashing green and red bars dancing across a screen. We had ticker tape, chalkboards, and the most powerful tool any speculator ever owned: our own observation. We watched price. We watched volume. We watched human behavior repeat itself, hour after hour, year after year. And the men who understood that behavior, they prospered. The men who didn't, they fed the market. Now, fast forward to your modern age. You have an indicator called the Relative Strength Index. It was developed by a fellow named J. Wells Wilder in 1978, a mechanical engineer turned trader. He created this indicator to measure something very specific: the speed and the change of price movements, the momentum, if you will, of a stock or a currency or a commodity. The RSI runs on a scale from 0 to 100. And from the very beginning, traders were taught two simple rules. When the RSI crosses above 70, the asset is overbought and you should sell. When the RSI crosses below 30, the asset is oversold and you should buy. Simple, isn't it? Too simple. And that, my friend, is precisely why 97% of retail traders lose money using this indicator. Because they treat it like a magic 8-ball. They shake the chart, they wait for a signal, and they take it without thought, without context, without confluence. Let me explain something to you that I learned in my 40 years of speculating. Markets are not mechanical. They are emotional. They are driven by fear and by greed, by hope and by despair. And no single indicator, no matter how mathematically elegant, can capture the full picture of human behavior on its own. When you see RSI reading 70, what does it actually mean? It means the recent upward price movement has been strong relative to the recent downward price movement over a defined period, usually 14 sessions. That's it. It doesn't mean the price is going to reverse. It doesn't mean the trend is exhausted. It doesn't mean you should sell. In fact, here's a secret most traders never learn in a strong trending market. The RSI can stay above 70 for weeks, sometimes months. I've seen great bull moves where the RSI was pinned above 80 for the entire ride. The trader who shorted at 70 was wiped out. The trader who held the long position to 90 made a fortune. This is the first illusion you must shatter. RSI is not a reversal indicator. It is a momentum indicator. And momentum, in a strong trend, is your friend, not your enemy. Let me give you a real-world example. Imagine a stock breaking out of a long base. Volume is expanding, institutions are accumulating, the price begins to rip higher. Within a week, the RSI hits 70. The amateur trader sees this and shorts. Why? Because his textbook told him to. Within 3 days, the stock is up another 15%. The RSI is now at 85. The amateur gets stopped out. Or worse, he averages down. By the time the stock finally cools off, he's down 40% on his account. Meanwhile, the professional trader, the one who understands what RSI actually measures, that trader is riding the move. He recognizes that an RSI of 70 in a strong uptrend is not a sell signal. It's a confirmation of trend strength. He's not looking for reversals. He's looking for continuation patterns, pullbacks, consolidations within the trend, opportunities to add to his winning position. Do you see the difference? It's not the indicator that's wrong, it's the interpretation. Now here's another secret. The standard 14-period setting for RSI is not sacred. It's simply what Wilder chose because it worked reasonably well across multiple markets and time frames back in 1978. But markets have changed. Liquidity has changed. Volatility profiles have changed. Many of the most consistent traders I've studied today use different RSI periods depending on their style. Scalpers may use a 9-period RSI for faster signals. Swing traders might use a 21-period RSI to filter out noise. Position traders might combine multiple RSI periods on the same chart to gauge momentum across different time frames. There's no single correct setting. There's only the setting that fits your strategy, your time frame, and your psychology. The second great illusion of RSI is that it works in isolation. Let me be clear with you, no indicator works in isolation. None. Not RSI, not MACD, not Bollinger Bands. Not the moving averages I'm sure you've memorized by now. Indicators are tools. They are not strategies. A hammer doesn't build a house. A carpenter does. And a carpenter uses many tools in concert to build something of value. In the same way, you must learn to use RSI in concert with price action, with volume, with market structure, and with the broader context of the market environment. Is the overall market in a bull phase or a bear phase? What is the sector doing? What is the trend on the higher time frame? These questions matter far more than whether RSI is at 68 or 72. The third illusion, and perhaps the most dangerous one, is that RSI signals are equally valid in all market conditions. They are not. RSI works beautifully in certain types of markets and miserably in others. In a strong trending market, traditional overbought and oversold signals will destroy your account. In a ranging market, those same signals can be highly profitable. The skill of the master trader is not in knowing the indicator, it's in knowing when the indicator applies. So as we move into the 3 advanced strategies I'm about to share with you, I want you to release everything you thought you knew about RSI. Forget 70 and 30 as automatic triggers. Forget the textbook signals. Forget what every guru on the internet has told you. We're about to go deeper. We're about to look at RSI the way a professional speculator looks at it, as a window into the soul of the market, as a way to measure not just momentum, but conviction. Not just price change, but the psychology behind the price change. Because at the end of the day, the markets are made of people. And people are predictable in their unpredictability. The same patterns that played out in 1907, in 1929 inches, 1987 inches, 2008, in 2020, those same patterns are playing out today. The tools have changed. The names have changed. But human nature, my friend, human nature has not changed one bit. And that's why the 3 strategies I'm about to teach you have stood the test of time. They are not based on mathematical hocus pocus. They are based on human behavior. On the way fear and greed move through a market like a tide. On the way smart money accumulates and distributes while the public chases and panics. Are you ready? Then let's begin with the first strategy, and I promise you, this one alone, if applied with discipline, can transform your trading. The first advanced strategy I want to share with you today is RSI divergence, but not the way the textbooks teach it. I'm going to show you how to combine RSI divergence with structural confirmation to create one of the most powerful reversal signals in all of technical analysis. Let me start with the basics, briefly, for those who may be new. RSI divergence occurs when the price of an asset moves in one direction, but the RSI moves in the opposite direction. There are 2 main types, bullish divergence and bearish divergence. Bullish divergence happens when price makes a lower low, but RSI makes a higher low. This suggests that even though the price is falling, the momentum behind the decline is weakening. The bears are getting tired. The selling pressure is fading. A reversal may be approaching. Bearish divergence is the mirror image. Price makes a higher high, but RSI makes a lower high. The price keeps climbing, but the momentum is fading. The buying pressure is exhausting. The bulls are losing their grip. A reversal may be approaching. Now, here's where most traders go wrong. They see a divergence form on the chart, and they immediately enter a trade. Boom, they short the bearish divergence. Boom, they buy the bullish divergence. And 9 times out of 10, the market keeps moving in the original direction, takes them out at a loss, and then finally reverses without them. Why does this happen? Because divergence alone is not enough. Listen to me carefully. Divergence is a warning. It is not a signal. It tells you that the current trend is losing steam. But losing steam does not mean reversing. A car can coast for a long time after the engine stops. A market can grind higher long after the buying momentum has peaked. The professional speculator does not trade divergence in isolation. He waits for structural confirmation. And that is what I'm going to teach you right now. Here is the 4-step process for trading RSI divergence with structural confirmation. Step 1. Identify the divergence on a meaningful time frame. I'm not talking about a 5-minute chart, unless you're a scalper with iron discipline. I'm talking about the 4-hour, the daily, or the weekly chart. Divergences on higher time frames carry far more weight than divergences on lower time frames. They represent a broader shift in market sentiment. A bearish divergence on a daily chart is worth 100 bearish divergences on a 1-minute chart. Step 2. Wait for the swing structure to break. This is the part that almost no one teaches. After you spot the divergence, you must wait for the underlying market structure to break before entering. What does that mean? It means waiting for the price to break below the most recent swing low in the case of a bearish divergence, or above the most recent swing high in the case of a bullish divergence. This break of structure is your confirmation that the trend has actually reversed, not just paused. Step 3. Wait for the retest. After a structure breaks, the market often pulls back to retest the broken level. This is where the smart money enters. Not on the initial break, that's where the amateurs jump in and get whipsawed. The retest gives you a much better entry price, a tighter stop loss, and a higher probability of success. Step 4. Enter with a defined risk and a defined reward. Place your stop loss just beyond the most recent swing high or low. Target the next major structural level, a previous support or resistance zone, a Fibonacci extension, or a key moving average. Always know your reward-to-risk ratio before you enter. I will not take a trade with less than a 2-to-1 reward-to-risk ratio. 3-to-1 is better. 5-to-1 is glorious. Let me walk you through a real example so you can see this in action. Imagine a stock that has been in a strong uptrend for 6 months. It's been climbing higher and higher, making new highs almost every week. The RSI has been bouncing between 40 and 80, confirming the strength of the trend. Then one day, the stock makes a new high. Let's say it climbs from $100 to $120 over the course of 3 weeks. But when you look at the RSI, you notice something interesting. On the previous high, the RSI was at 85. On this new high, the RSI is only at 72. That's a bearish divergence. Does the professional trader immediately short the stock? No, he waits. He marks the most recent swing low. Let's say it was at $112. Then he watches and waits. Over the next 2 weeks, the stock pulls back to $115, then bounces to $118, then falls again, and this time it breaks below 112. The swing low is broken. The structure has shifted. Now the professional is interested. He waits for the retest. Sure enough, the stock rallies back up to test the $112 level, which now acts as resistance. The stock rejects this level. It can't get back above it. Now the professional enters short. His stop loss is at $115, just above the most recent swing high during the retest. His target is the next major support level, let's say $100. That's a 3-to-1 reward to risk trade. and the probability of success is much higher than if he had shorted at the first sign of divergence. That is how a professional uses RSI divergence, not as a magic signal, but as a piece of a larger puzzle. Now, I want to share with you something even more powerful. When you combine RSI divergence with what I call key levels, historical support and resistance zones, major round numbers, previous all-time highs or lows, the probability of success increases dramatically. Why? Because at these key levels, you have the maximum amount of market participation. You have buyers who bought at this level years ago and are now finally getting back to break even. They sell. You have stop losses clustered above and below these levels. They get triggered. You have algorithmic traders programmed to react to these levels. They execute. The volume explodes. The volatility spikes. And if you have a divergence forming at a key level, with a structural break and a clean retest, you have one of the most asymmetric opportunities the market can offer. Let me give you one more piece of wisdom on this strategy. Patience is everything. You may go weeks without seeing a setup that meets all 4 criteria. That is not a problem. That is a feature. The fewer trades you take, the more selective you become, the higher your win rate will be. I would rather take 10 high-quality trades per year and make 30% than take 500 mediocre trades per year and lose 10%. The market will always be there. The opportunities will always come. Your job is not to catch every move. Your job is to catch the right moves, and to size them properly, and to manage them with discipline. This is exactly the kind of disciplined, patient mindset I write about extensively in my ebook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. If this strategy resonates with you, that book will deepen your understanding tenfold. The link is in the description below. Now let us move on to the second strategy, and this one, my friend, is where the real money is made. The second advanced strategy I want to teach you today is one that most retail traders have never even heard of. It's called the RSI 50-line trend continuation strategy. And once you understand this concept, you will never look at the RSI indicator the same way again. Most traders fixate on the 70 and 30 levels. Overbought, oversold, buy, sell, as if the entire indicator can be reduced to 2 horizontal lines on a chart. But the real magic of the RSI, the part that the professionals use and the amateurs ignore, happens at the 50 level, the middle of the indicator, the dividing line between bullish momentum and bearish momentum. Let me explain why this level is so important. The RSI is essentially a measure of buying pressure versus selling pressure over a defined period. When RSI is above 50, it means buying pressure has been stronger than selling pressure. When RSI is below 50, it means selling pressure has been stronger than buying pressure. The 50 level is the equilibrium point, the boundary between bull territory and bear territory. Now, here is the secret. In a strong uptrend, RSI rarely drops below 50. It will fluctuate between 50 and 80, bouncing off the 50 line like a basketball off a hardwood floor. Every time it touches 50 and bounces, that is a high probability buying opportunity. The trend is intact. The momentum has cooled. The pullback is providing a fresh entry. In a strong downtrend, the opposite is true. RSI rarely climbs above 50. It fluctuates between 50 and 20. Every time it bounces off 50 to the downside, that is a high probability shorting opportunity. This is the foundation of the RSI 50-line trend continuation strategy. You're not trying to catch reversals. You're trying to ride trends, and the 50 line is your entry signal. Let me walk you through the precise steps. Step 1. Identify the trend. Before you can trade trend continuations, you must first establish that a trend exists. There are many ways to do this. You can use moving averages, for example. If the price is above the 200-day moving average and the 50-day moving average is sloping upward, you have an uptrend. You can use higher highs and higher lows. If the price is consistently making higher highs and higher lows over your chosen time frame, you have an uptrend. You can use the slope of a trend line. You can use the directional movement index. Whatever method you use, be consistent and be rigorous. Step 2. Confirm the trend with RSI behavior. This is where it gets interesting. Once you've identified the trend, look back at how the RSI has been behaving. In a strong uptrend, you should see the RSI consistently making higher lows on the indicator itself, and those lows should be bouncing off or above the 50 line. If the RSI has been respecting 50 as support during the uptrend, you have a confirmed RSI trend. Step 3. Wait for the pullback. Markets do not move in straight lines. Every trend has its corrections. Every advance has its retreats. Your job is to wait patiently for the pullback. As the price corrects, the RSI will drop from its higher reading, perhaps from 75 down toward 50. Do not anticipate. Do not enter early. Let the pullback play out. Step 4. Enter on the bounce from 50. When the RSI approaches the 50 line and then turns back up, that is your entry signal. You're entering on a pullback in a confirmed uptrend, with momentum about to resume. This is the highest probability entry in trend trading. Step 5. Manage the trade with structural stops and trailing exits. Place your initial stop loss below the most recent swing low in price. As the trade moves in your favor, trail your stop using either a moving average, the most recent swing low, or a percentage-based trailing stop. Let the trend run. Do not cut your winners short. Most traders fail not because they don't catch good trades, but because they exit good trades too early. Now I want to share with you a sophisticated variation of this strategy that the professionals use. It's called the RSI 50 line failure swing. Here's how it works. In a strong uptrend, RSI bounces off 50 consistently. But every now and then, the RSI will dip slightly below 50, maybe to 45 or 48 before bouncing back above. This temporary failure to hold 50 is actually one of the most powerful continuation signals in the entire indicator. Why? Because it shakes out the weak hands. The traders who are watching the 50 line as support get nervous when it breaks. They sell, they panic, and then the price reverses and rips higher, leaving them stranded on the sidelines while the smart money loads up. When you see the RSI dip below 50 in a strong uptrend and then quickly recover, that is not a sign of weakness. That is a sign of strength. The market is testing its own resolve and passing the test. The professional uses this dip as an opportunity to add to his position at a discount. Of course, you must combine this with price action. If the RSI dips below 50 and the price also breaks a major support level with high volume, that's a different story that may be the beginning of a true trend reversal. Always look at the indicator in the context of the price. Always. Let me give you another example. Imagine a currency pair that's been in a clear uptrend for 2 months. It's making higher highs and higher lows. The 50-day moving average is sloping upward. Price is well above the 200-day moving average. The RSI has been ranging between 50 and 75, bouncing off 53 times in the past 2 months.